Well, the stock market's in trouble right now. Stocks like Tesla are absolutely getting smoked, Palantir is getting smoked, the Nasdaq is getting smoked, interest rates are going way up, and the CME Fed Watch Tool is projecting one interest rate cut for this entire year. We were expecting 4 cuts, now we're expecting to get 1 cut. This is the sole reason why the Nasdaq in 2022 went down 35%. Yes, 35%, because of the one thing that we're going to talk about in this video right here. So we're going to start out over here on my 100% free alpha report. The link is below if you want to get it. You can see the market is red, and you can see the fear greed index right now. We are now in the fear category, almost in the extreme category right here. And the biggest problem of all is that bond yields are going up. This has massive market implications. So let's dive into what's going on right now and why we're in this fear category right here. So what just happened recently is we did get some jobs data, and the jobs data right here came out pretty strong. The unemployment rate fell to 4.1%, and we were expecting 4.2%, and the economy added over 250,000 jobs, and only 165,000 jobs were expected. So you're probably going to say, like, Brandon, why is the stock market going down when the economy is strong? Interest rates are everything when it comes to the stock market. If interest rates go up, the stock market's going to go down most likely, and if interest rates go down, the stock market's probably going to go up. So right now, our current interest rate range is 4.25 to 4.5%. You could see for the December 10th of 2025 meeting right here, interest rates are most likely to be from 4% to 4.25%. So that is indicating one 25 basis point interest rate cut for all of 2025. That is way below expectations, and that is why the bond yield is going up. So check this out. Since the Fed started cutting interest rates, we went from 3.6% on the 10-year bond to now 4.76%. So now the question is, do you want to go get a risky 10% return in the stock market, or do you want to get a guaranteed rate of return of 4.7%? Interest rates started to get raised in this period right here, and look what happened. The market corrected down. Then as interest rates were starting to get cut, the market pumped back up. But guess what? Now that we're supposed to get less interest rate cuts versus what was expected, the CME Fed Watch Tool is only pricing in one interest rate cut of 0.25% this year. Bond yields are pumping. So let me ask you this right here. Do you want to put your money all in the stock market right now for the next 10 years? Well, you're going to say, well, if the market's 10 to 20% overvalued right now, what if it goes down 20% and then it takes a few years to get my money back to even? That is totally accurate. And that is why the 10-year treasury bond looks very attractive at a 4.76% level right here. At a time that the market is overvalued and the yields are pumping on the bond, people are going to say, do I want to get a risky 10% per year, which is what the stock market does on average over a long period of time, like 50 years? Or do you want to go get a guaranteed rate of return for 4.7% in a 10-year bond? I am considering in my $2 million portfolio to allocate some money to a bond right now because stock valuations are a little bit lofty. You guys know I make about $30,000 every month with stock options, but right now I am being very careful the plays that I'm sending out there right now, because if the market goes down as a whole, whether I do it on an individual company or the stock market in general, those plays will probably go down in value. So you have to be very careful right now because the market's overvalued at a time that interest rates are going up on bonds. And you guys can see right here that the fear greed index is saying we're at 27, which is pretty fearful, almost in the extreme fear category. But just a few weeks ago, we were in the greed and extreme greed category right here. I mean, just look at Tesla stock. Tesla stock, right around the election when Trump got elected, it pumped from 250 all the way to almost $500 per share. Tesla stock basically doubled in just a few months. Now ask yourself this question right here. Is the whole value of Tesla as a company, don't think of the stock price, just think of Tesla as the company. Did the value of Tesla double in 2 months by Trump getting elected? Absolutely not. So that is why we're seeing right here this blow off top happening right here, and who knows how low it can go. Right now I'm selling calls on Tesla. It's kind of a bearish play, and I've been generating a few $1,000s every week doing that play. I do a bunch of other stuff, but that is printing money for me right now. It's pretty much like guaranteed money right now because I feel like Tesla's overvalued and this blow off top was due. And Warren Buffett said it best: be greedy when others are fearful and be fearful when others are greedy. So when people are fearful, this is the time to be greedy. I mean, you can see Triple Q right here topped out somewhere around $540 per share, and we're right around 507, so we're only down a little bit. So I don't think we're truly this deep into the fear category. I think that when this needle's like at 10, that would be a time that I will be going out there and buying a bunch of stuff. but it does depend on evaluation levels. So we have to get into right now why treasury bond yields are pumping, because if they continue to pump, the stock market is going to get smoked. So you have to understand this information in your portfolio if you own anything long right now. Long meaning you just think the price is going to go up. So like we talked about earlier, the jobs data came in strong. So you're going to say, Brandon, if the economy is so strong, why is the stock market going down? And it all comes down to that competition between stocks and the bond market. So a strong economy is typically linked to having more inflation. If the economy is strong, people have money, they want to go blow money, they have more money to spend. If you spend more money, there's going to be upward inflation pressure. So if you look at this chart right here on my Alpha report, this is a chart of inflation since 2004. So we were up here at 9.1%. Now we're around 2.7% right here, which we are close to the Fed's target of 2%, but the job is not done. Jerome Powell at the Federal Reserve stated very clearly, until we hit 2% and we feel like we're going to stay at 2%, our job is not done. And look at this little bump that happened right here. Inflation was down to like 2.4%. Now it ticked back up to 2.7%. And the data that we're expected to get pretty soon, inflation is expected to tick up even higher. So at a time that the economy is strong with this strong data right here, and also at a time that inflation is ticking up a little bit, there's going to be more pressure from the Federal Reserve to not cut interest rates, because a strong economy with upticking inflation, you're probably going to want to keep interest rates higher for longer to try to keep inflation down. Just look at the CME Fed Watch Tool. This is 1 year from right now pretty much. We're expected to get one 25 basis point cut, and there's actually a 31% chance we get no cuts. Literally 31% chance of no cuts. And then if you add these two together, which is like 72%, a 72% chance we're going to get one 25 basis point cut. That is bad for the stock market, because stock market valuations are a little bit high right now, and people are going to want to go put their money into a bond. But here's the big silver lining. Here's the big what if situation. If this happens, the stock market will not go down, and the stock market will absolutely continue to pump. This is just turbulence in the road, possibly, and this is a scenario why you could do whatever you want with it. I'm just going to give you the data, and I'll give you my opinion in just a little bit. So from this time period right here, from 2008 to 2020, so 2008 right here to 2020, you could see the inflation in that 12-year time period was right around 2%. So 2% inflation, right at the Fed's target, and guess what? Interest rates were low in that time period too. They were in a range of 0 to a couple percent in this whole time period right here. And there was minimal inflation and the economy was strong. Just look at that on a stock chart right here. Look at the max chart right here. If we go from that similar time period from 2008 to 2020, the stock market absolutely pumped in that time period right here. It went from like $30 a share all the way up to $170 per share. So it went up a lot in that time period. So just because we had a strong economy, that didn't necessarily correspond to inflation in that period right there. So this is the bullish argument right now. And then I'm going to give you a surprise to why I think the stock market could absolutely go even higher from this level right here if it actually plays out. So like I said, we had a massive run from 2008 to 2020, low inflation, strong economy, low interest rates. We get all that. But the market right now is not expecting that scenario to play out going forward. The market is expecting inflation to tick higher, the Fed keeps rates higher for longer, and a 10-year bond is expected to go higher. That is what the market's pricing in on top of one 25 basis point cut right here. But here's what I think. I think that inflation concerns are totally blown out of proportion right now, and I feel like as time goes on, it will be bumpy, but I feel like inflation will continue to trend downward. Not every month, it will be bumpy, but on balance, I feel like we are going to trend lower on inflation. And when those inflation reports start to come out over the next coming months, I feel like the market is going to start to price in more interest rate cuts because, yeah, the economy is pretty strong, but inflation is trending lower, so then it's going to be okay to cut interest rates even more. And when that happens, the 10-year Treasury bond is going to go down. When that goes down, the stock market is going to go up. Look at right here on a 5-year basis right here. They raised rates, the market went down. But when the Fed signaled they were going to start to cut rates, the market went up right here. So we could expect to have a little bit of turbulence here for the next couple months, which is what I think. But then once inflation continues to trend lower, maybe the economy will soften a little bit. The Fed is going to be okay to cut interest rates even more, and this will price in more interest rate cuts. bond yields are going to go down and the stock market's okay to go higher. And remember, stocks and bonds compete with each other. So stocks are assumed to be the risky 10% return every single year. I get it, stocks go up 40% some years, they go down 40% other years. But in the long run, the stock market averages roughly 10% per year. It just depends on when you start your data, to be honest with you. So do you want to get a 10% risky return right now, or do you want to get a guaranteed risk-free return of 4.7%, which is a 10-year bond right now? That is the debate right now. 10% risky return at a time the market's overvalued, or a guaranteed 4.7% on a bond. So that is why the market's having downward pressure, because this is a little bit more attractive right now than this right here. And it's no wonder why Warren Buffett has so much cash on the sidelines right now, because he is expecting a stock market pullback. He likes to buy when things are on sale. He likes to buy when other people are being fearful. I also like to buy when people are fearful. So here's how I plan to capitalize on it. I think inflation, like I said, is going to trend lower in the coming months, and this is going to cool down the bond yields. I think when that happens, this bond is going to start to trend down, and that's going to give a little bit of relief to the stock market. That's where I said stocks will bounce back right here. So the plan for me in my $2 million portfolio is to find companies that are trading below intrinsic value with a durable competitive advantage going forward, and I will use options to magnify my returns. Right now I generate roughly $30,000 per month in option premiums, but this is also at a time that I feel like the market is a little bit overvalued, so I have less conviction in the option plays that I'm making, so I'm making less plays right now. But if the market goes up a lot and it's not justified, I'll be on the bearish side and I'll sell options or buy puts. But if the market goes down and we get into that cheap category right there, I'll be buying calls, I'll be selling puts, and I will be magnifying the returns in my portfolio when we get a bounce back. Just look at what happened in this time period right here. 2021, the market dipped 35% down to this level right here. I was buying calls and I was selling puts like crazy in this time period right here. And this bounce right here made me millions and millions of dollars. So that is the name of the game. If you guys want to learn more about my options trading strategy, do my course below. It's 60% off. Prices will go up soon. If you don't want to do my course, watch this video right here. It's a basis of how I do stock options. I'll see you guys there.